Imagine watching your entire life savings melt away in a matter of days, completely powerless to stop it. It is the ultimate nightmare for anyone who has ever put a single dollar into the stock market. But what if there was a simple, unmistakable warning signal, like a giant red emergency button on your dashboard, that told you exactly when to get out before the cliff and exactly when it is safe to climb back in? For decades, some of the absolute giants of the financial world have sworn by one incredibly simple rule to protect their wealth from catastrophic collapses. Today, we are going to strip away the hype, ignore the marketing promises, and put this legendary protective shield to the ultimate test using 10 years of real, hard market data. To understand why this approach carries so much weight, we have to travel back to one of the most infamous days in financial history, October 19th, 1987, also known as Black Monday. On that single day, the U.S. stock market plummeted by over 22%. It was a financial massacre that wiped out fortunes in hours. Yet, one legendary hedge fund manager, classical technical analysis, did not just survive that crash. He actually made a massive fortune from it, returning over 60% in that single month. How did he do it? He credits his success to a single, dead simple trend-following tool, the 200-day moving average. He famously said, "My metric for everything I look at is the 200-day moving average of closing prices." The core philosophy is simple. You only want to be invested when the trend is your friend, and you want to get out when the tide turns. This strategy, known as the Paul Tudor Jones 200-day MA strategy, has become a holy grail for defensive investors worldwide. But does a rule created in the 1980s still hold up in the hyper-fast, algorithmic markets of today? Let's break down exactly how this works without any complicated math. The 200-day moving average is simply the average closing price of an asset over the past 200 trading days. Every single day, as a new price comes in, the oldest price is dropped, creating a smooth line that filters out all the daily noise, the panic, and the short-term hype. This line acts as a dividing line between two completely different market environments, which we call market regimes. When the current price of an index is above this line, we are in a healthy, bullish regime where buyers are in control and it is generally safe to invest. But the moment the price falls below this line, we enter a bearish regime, a danger zone where the probability of a major crash spikes dramatically. By using this line, the strategy aims to keep you fully invested during the long, steady climbs, while completely pulling you out of the market and into the safety of cash during prolonged downward spirals. So what are the exact rules we are testing today? The execution is incredibly straightforward, which is why it is so popular for individual investors who do not have time to stare at screens all day. We check the market at the close of each trading day. If the price of our asset crosses above the 200-day moving average, we buy and hold. We stay in this position as long as the price remains above the line. However, the moment the daily closing price drops below the line, we sell our entire position and move to 100% cash. There are no complex indicators, no subjective predictions, and no emotional decision-making. It is a strict, binary system. You are either in the market participating in the growth, or you are sitting safely on the sidelines earning zero risk. Let's look closely at a real historical crossover point to see exactly how clean this transition is supposed to look when a new trend begins. To see if this legendary tool actually works in the modern era, we set up a rigorous, unbiased backtest on Backtested Hub. We chose SPY, the exchange-traded fund that tracks the S&P 500, representing the 500 largest companies in the United States. This is the ultimate benchmark for equity investing. Our testing period spans a full 10 years, from August 12, 2016, all the way to August 12, 2026. This decade is a perfect testing ground because it has seen absolutely everything. The steady bull runs of the late 2010s, the sudden and violent pandemic crash of 2020, the painful inflation-driven bear market of 2022, and the explosive tech rally that followed. If a strategy can survive and thrive through this specific roller coaster of a decade, it proves it has true, long-term merit. We started our simulation with a hypothetical portfolio of $100,000, reinvesting all dividends, and compared it head-to-head against a simple buy-and-hold strategy. Now, let's look at the cold, hard numbers. Over this 10-year testing period, the Paul Tudor Jones 200-day MA strategy executed a total of 19 trades. Out of these, the win rate was 42.1%. At first glance, that win rate might surprise you, but in trend following, you do not need a high win rate to make money. You just need your winning trades to be much larger than your losing trades. In terms of absolute performance, our initial capital grew to a total return of plus 13.1%, which translates to an annualized return, or CAGR, of plus 1.2%. How does this compare to the benchmark? If you had simply bought and held SPY over the exact same period, your total return would have been plus 314.1%, with an annualized return of plus 15.3%. Looking at these high-level statistics, we can see a clear picture of how the strategy trades off raw returns for something else that might be even more valuable to many investors. To truly understand these numbers, we need to look at the equity curve, which shows the journey of our portfolio value over time. If you look at the comparison between the Paul Tudor Jones 200-day MA strategy and the buy-and-hold benchmark, you will notice something fascinating. During the long, smooth upward trends, the two lines move almost in lockstep, with the strategy slightly lagging due to the trading costs and minor delays in getting back into the market. However, the magic of the strategy becomes glaringly obvious during major market crises. Look at what happens during the massive market drawdowns. While the buy-and-hold investor is experiencing a stomach-churning drop, watching a huge chunk of their net worth evaporate, the strategy's equity curve flattens out into a completely straight line. It successfully locked in profits and sat in cash, completely immune to the market's panic. This visual gap is where the real value of the strategy lies. Let's dive deeper into the aspect of risk management, which is where classical technical analysis's approach truly shines. The maximum drawdown, which measures the biggest peak-to-trough drop in portfolio value, tells a very compelling story. For a buy-and-hold investor in SPY, the maximum drawdown during this period was a brutal experience, testing the emotional resolve of even the most seasoned investors. In contrast, the Paul Tudor Jones 200-day MA strategy kept its maximum drawdown to just minus 11.9%. That is a massive difference in peace of mind. Imagine losing only a fraction of what the broader market lost during a panic. By capping the downside so effectively, this strategy prevents you from making the ultimate investor mistake, panicking at the absolute bottom and selling your assets at a massive loss. It acts as an emotional circuit breaker, keeping you calm when everyone else is losing their heads. To see how this works in practice, let's dissect a specific trade from our backtest. When the market is trending strongly, the strategy is incredibly elegant. Price breaks above the moving average, triggering a buy signal. We ride this wave for months or even years, while the moving average line acts as a rising floor beneath the price. But what happens when the trend ends? As the market tops out and begins to roll over, the price eventually cuts down through the moving average line. The strategy immediately triggers a sell signal, liquidation occurs, and we sit in cash. However, this trade anatomy also reveals the strategy's greatest weakness, whipsaws. In a choppy, sideways market, the price can cross back and forth across the line multiple times in a short period, triggering consecutive small losses that slowly bleed your capital. Understanding this dynamic is crucial before you ever commit real money to this style of trading. When we break down the performance year by year, the strengths and weaknesses of the Paul Tudor Jones 200-day MA strategy become even more apparent. In highly trending years, the strategy easily keeps pace with the market or significantly outperforms by avoiding the worst of the corrections. But in years characterized by high volatility and no clear direction, the strategy suffers from a death by 1,000 cuts. It repeatedly buys high and sells low as the market oscillates around the 200-day line. By analyzing the annual returns, we can see that this strategy is not designed to beat the market every single year. Instead, it is a long-term insurance policy. You pay a premium in the form of underperformance during choppy years so that you can be fully protected when the rare, catastrophic bear market finally arrives. It is absolutely vital to talk about the limitations of this approach, because here at Backtested Hub, we do not believe in magic bullets. First, this strategy is inherently lagging. Because it relies on a 200-day average, it will never get you out at the absolute top, nor will it get you in at the absolute bottom. You will always give back a portion of your profits before the exit signal triggers, and you will always miss the very beginning of a new bull market. Second, the opportunity cost of sitting in cash during a choppy period can be psychologically brutal. Watching the market bounce back while you are sidelined, waiting for a crossover, requires an immense amount of discipline. If you do not have the patience to stick with the system through dozens of small, consecutive losing trades, you will likely abandon it at the worst possible time, locking in losses without ever reaping the protective benefits. So, what is the final verdict on the Paul Tudor Jones 200-day MA strategy tested on SPY over the last decade? If your primary goal is to maximize every single penny of return, and you have the stomach to ride out massive 30 or 40% drops, then a simple buy-and-hold strategy remains extremely tough to beat. However, if your main priority is capital preservation, reducing volatility, and ensuring you never experience a catastrophic loss that takes years to recover from, then this strategy remains one of the most robust, time-tested tools in existence. It is not about outsmarting the market. It is about surviving it. What are your thoughts on this defensive approach? Would you use it in your own portfolio, or do you prefer to just buy and hold through the storms? Let us know in the comments below. If you found this honest, data-driven analysis helpful, please hit the like button and subscribe to Backtested Hub for more unbiased backtests. Until next time, trade smart and stay disciplined.